Welcome to episode 82 of the Cashflow Connections podcast. The topic for today is, what do rising interest rates actually mean for cap rates? The idea is simple. The more interest rates go up, the more expensive borrowing money becomes. The more expensive borrowing money becomes, the less debt the same property can substantiate. And as the amount of debt a property can substantiate decreases, property values decrease because the same purchase will require a larger and larger down payment. And as that happens, property values decrease, meaning that cap rates go up because there's an inverse correlation between property values and cap rates. Now, what this means is that as interest rates rise, cap rates rise as well. At least that is how it's supposed to work over the long term, all things being equal. But of course, the long term can be a lot longer than most people think, and quote, all things being equal is code for in a completely theoretical world, because there's so many uncontrollable variables out there that no one really knows what they're talking about. So today, we're going to get to the bottom of what rising interest rates actually means for real estate investors, for cap rates, and for the international financial markets. We're going to talk about a lot of different topics today. One of the things we're going to focus on, though, is why watching unemployment is actually critical if you're going to try to predict anything about interest rates. We're also going to discuss why rising interest rates has a big impact on virtually everyone's lives, not just people that are buying houses. And we're going to have our guest give his prediction about what's the outcome going to be of these unheard of monetary policies which have taken place since 2008. So a lot of interest rates, a lot of cap rates, a lot of Fed discussions, and some predictions. A lot of great content. Hey, you know what I can't do enough? I'll tell you. Thank you, listeners out there. So let me just take a moment right now to do it. Truly, thank you very much for your continued support. Thank you for the comments. Thank you for the subscriptions. It really means a lot. I've said it before. I'll say it again. I love doing the show. You guys make it possible, so thank you for everything. Of course, if you haven't yet subscribed, make sure to do so in iTunes. In the podcast world, iTunes is basically the name of the game. So make sure you subscribe on the podcast app or in the iTunes store. This is how you automatically get episodes directly downloaded, which means next time you get stuck without the internet, you don't have to sit around pouting because you already have the episode ready to go. Or if you're driving, go through a dead zone, you got a long car ride. Well, if you subscribe, already got awesome content on the phone. So make sure to do that. And for those of you that are already subscribed, thanks again. All right. Hope you enjoy the episode. How's it going, everyone? Our guest for today is Mike Zlotnik, who is the CEO of Tempo Funding, as well as the founder of TH Management Groups, which are real estate investment companies. He has been a debt and equity investor in real estate since 2000 and has always had a passion for it because of its predictability of outcome as well as its understood risk. And I use both those terms all the time because I really like those elements of real estate as well. Mike is also a member of multiple real estate and mastermind groups, including Collective Genius, which you may remember from one of our previous episodes. And he's also the host of a podcast called Big Mike Fund, and that can be found at bigmikefund.com or in iTunes. So, Mike, thanks again for coming on.
Ander, thank you very much for having me.
So today we're going to talk about interest rates and real estate. And obviously this is a massive conversation because anytime you get into the conversation of debt, you're talking about not only things that are involving real estate, but pretty much every single transaction that's taking place to one extent or the other. And I'm really interested to get your perspective on this from a big picture, but I also want to start with real estate and then we can kind of spread out. So let's talk about the current interest rate environment. Give us your perspective on what this environment currently is and how it pertains to real estate and what this really means for the real estate market and for real estate investors.
Sure. We are mostly stabilized, slightly rising interest rate environment. As you know, Fed has indicated that they will consider slowing down further increases depending on the data. I don't think they're done yet, but they will certainly reflect on data across the board. The data they're looking at are some fresh sources of data that they've been asked to look at. Specifically, real estate markets have shown some level of softness. And in essence, Fed expected that. So the reason for the concern that the Fed is not done is because they have only one tool, and that's interest rate and money supply. And effectively, they want to raise rates a little bit more to slow down the inflation given current unemployment conditions. So they're still concerned about inflationary pressures. So that's effectively the market today. We're looking at slightly more Fed rate increases, and possibly that we'll see what happens with the economy, that the long-term bond might go back up over 3%, and so will the interest rates go up slightly. But I'm not expecting anything major in 2019.
Okay, fair enough. And you definitely touched on the employment situation, which I certainly want to get your perspective on because it's a driving factor of this entire conversation. Before we jump into that, though, in terms of real estate, when it comes to the actual market itself, when you're in this stabilized yet, most people anticipate that we are in a, quote, rising environment in the sense that the likelihood of rates falling is very, very low. The likelihood of it rising is very, very high. From your perspective, what type of investment strategies are people more likely to implement, or what does this really imply from someone who's looking at their portfolio from a strategic perspective, knowing that they're going into a rising environment?
So I would say defensive strategies are much more prevalent in today's environment. So what does that mean? Well, the rising interest rates have hurt affordability. So there's a significant shift from more expensive assets in the residential side of the real estate to more affordable stuff. So the demand for affordable housing doesn't mean cheap stuff, just relative to an average house in a given area. The demand for average or below is going to be reasonably strong. The demand for above average is going to weaken. So if you are investing capital, probably look at the affordability range. So the turnkey property range, possibly slightly above our investment grade. On the commercial side, investing today into retail prices is absolutely a bad idea. What is good idea is picking your battles very carefully for projects that have significant value add, and you can have downside protection through the value add component of a life cycle. And focusing on cash flow. So in this environment, cash is the king. As the economy softens, the cash flow is going to differentiate the winners from the losers. So projects with strong cash flow, projects with value add is what I would look at today.
Yeah, and it's actually an interesting conversation to be had because when you're looking at value add, you're most likely incurring risk to implement that value add. So a perfect example of value add is buying a C-class property and turning it into a B-class property or something similar to that. It's a big picture perspective, right? So when you do convert units from B-class to from C-class to B-class, you're incurring some sort of risk because you're going through some kind of capital expenditure. However, the idea is that that risk is offset by the increased return. That's one side of the coin. Now, the other side of the coin, to your point, is when you're late in the cycle, you need to ensure that you're forcing that value add. So yes, you are potentially increasing your return profile, but also you're padding your equity position when it comes to downside protection. Because if you're increasing rents from $700 a month per unit to $1,300 a month per unit, you're really able to withstand a correction if those $1,300 a month rents need to go down to $1,100 a month. The challenge is when you're buying fully stabilized assets at retail prices, you're explicitly relying on the cap rate to provide that return profile. You're probably going to be in a challenging situation. Is that a fair way to summarize kind of the theory behind what you just outlined?
Yeah, I think Hunter, you did a great job summarizing it. Yeah, buying fully stabilized property at the current cap rates, I don't want to call it suicidal, but it's dumb and dumber money. It's really, you're buying yield, pretty bad yield, and you're really risking economic slowdown, losing some occupancy, and then losing cash flow and decreasing the value of assets with rising interest rates or economic slowdown. So retail is not a non-starter. Conversion projects or improvement projects where you are increasing from, I want to have a major jump from 700 to 1,300. That's a massive, massive improvement. I would say projects that are poorly run, occupancy hovering somewhere in the low 80s, rather than taking on 50% heavy lifting, 50% occupancy projects, and incrementally improving them and raising rates, say, 15, 20%. That's the lower risk projects, but you still have sufficient upside to improve the cash flow without major risk of conducting heavy renovations. And for some reason, the B area buyers don't want to move in that apartment complex. So Strategic repositioning is harder. It's possible. If you could do that, that's a great upside. But even if you don't reposition, if you just take a C property and make it into C plus and increase the rates a little bit, that's probably good enough to give you downside protection and improve your cash flow and the value with it.
Yeah, very, very fair point. I think maybe taking a property from 700 per month to, let's say, 950, I think would be more common.
Exactly.
Maybe, something in that range. Okay, cool. So going back to interest rates in the Fed real quick, I think we kind of outlined the defensive strategy. I'm very much aligned with that. So when I look at anything, whether it is economics, and really economics is really everything, but when I look at any kind of structure, incentive alignment structure, any potential investment, I'm really focusing on looking at what the operators stand to gain. And so when it comes to the political structure or the Fed structure, I want to look at how they're positioned to get the most out of what they're trying to do, right? It's like, what's going to make their life easy? What's going to make their life better? And I'm trying to understand what they will likely do based on that incentive structure, because over the long term, they will act on their own incentives. So from your perspective, the Fed, how are they incentivized? What are they incentivized to do over the long term generally?
Well, in theory, Fed is an independent body of political movements. They have dual mandate, is to keep full employment and to keep inflation in check. So those are theoretically their primary drivers. And most of the folks on the Fed are reasonably independent. They might have some political affiliations and some political pressures that they deal with. But I'm convinced that they're not going to succumb to massive pressure and Trump yelling at Fed chair to keep the rates low. I certainly don't think they're going to make decisions based on political pressures. The incentive is certainly keep economy rolling and not to let employment get out of control. Sorry, not employment, but inflation. The employment is full. It's really hard to improve. So they only have a downside on that. And they're probably not concerned if the unemployment rate gets a little bit worse. What they are concerned about with full employment is that inflation will pick up. And we haven't had a great inflation over, again, the reported inflation. Now we're talking about CPI. We're not talking about the street inflation. We all know that the street inflation appears to be higher than the reported inflation for many reasons. So the Fed motivation is to keep CPI in check, and they will push the rates up if they see CPI data significantly accelerating. But we are now in a period of time where corporate earnings are slowing down. There is certainly volatility of the stock market, and some sectors of real estate have taken some level of beating. So the economy is slowing down. And the result of that is probably the inflation is not going to be putting too much pressure on Fed. So they'll probably keep, let's call it stable environment. They'll go neutral maybe after one or two more increases. And then we will be approaching political year of elections, and they'll probably try to maintain reasonable neutrality. And I believe that the primary risk to the economy is Fed doing anything fast. And then they've done it over the last couple of years, and now they realize they've made a few mistakes. So I think they're going to slow down and go a lot more. They'll go neutral a lot faster than they were thinking earlier. And neutral just means they're going to have wonderful meetings. They're going to have their meeting minutes published, and it's going to be nothing exciting. It's going to go in a very boring, nothing's happening mood soon enough. And that's probably good for the economy. Let the economy manage for the next couple of years rather than Fed putting more pressure. So the status quo and not let the economy go into accelerated recession is going to drive them much more than the political pressure.
That makes sense. And I agree with you that it's really about that predictability. The markets want the predictability. And I think that previously there has been active Fed members that have really created uncertainty, and also potentially a lot of people would make the argument that have, directly caused recessions as a result of raising rates too quickly. Now, of course, this is under the assumption, under the guise of legitimacy, when in reality is the market is not really dictating this. And so when we talk about the Fed doing anything, it's really a tampering with the market to some degree or another. To be honest, we don't really know to what degree, because the entire global economy has been so tampered with that there's really no way of knowing what rates would really be at. But it is important to mention that this is a centrally planned economy, essentially, based on the fact that every transaction, every debt transaction is based on interest rates, which are centrally controlled. So that's the framework by which this conversation is taking place. So
yeah, I have a quick comment on that.
Yeah.
So the interest rate manipulation is a socialistic structure. I grew up in the former Soviet Union many years ago. I ran away as a political refugee. I can tell you that system sucks. The government manipulation of anything generally fails miserably. So the Fed function is to help economy move through peaks and valleys smoothly. And the U.S. economy continues to get higher and higher degree leverage. So debt to GDP ratio continues to get worse over time. What does that mean? It means that the economy just can't afford high interest rates. So in the long run, the chances are the rates just can't go up too much because we're going to hit a period of hyperinflation and there are going to be bigger problems. So I think U.S. slowly over time moves towards Japan model with having bigger and bigger debt liabilities on the balance sheet and needing to maintain lower and lower interest rates. And this is not just on the federal debt level. This is also true on many state, municipal, and corporate debt levels. Everything seems to be dependent on debt and a cost of debt. So high interest rates, even slightly high interest rates, creates very significant pressure on the economy because the economy is so over-leveraged on debt.
I'm really glad you said that, because if there was a Cashflow Connections podcast drinking game, there would certainly be a portion where you have to drink every time I or the guest mentions Japan. And so it always makes you feel good when the guest mentions Japan first, because that means that we're on the same page. And I've mentioned this many times, and this is why, because I completely agree with you. I think that the Japan model has basically been the template now for not only US, but of a lot of economies all over the world. And I think that that's exactly where the U.S. is headed over the next 20, 30 years in a big picture way. I don't think it's going any other way than that because of the fact that the liabilities are so large. Now, I wanted to circle back real quick about employment, because this is a really important tie-in that I wanted to focus on. So we're basically historically quite low in terms of unemployment, which is good. Most people have jobs. The unemployment rate is quite low. If you look at the history of it, it's actually going back many, many decades before the last time that unemployment rate was so low. So what does this mean for interest rates, and how is employment and interest rates so interlocked?
Yeah, it's a great question. Well, the theory behind low unemployment is that it'll cause wage inflation. When we talk about inflation, there's a few sides to inflation. There's wage inflation, commodity inflation, but the wage inflation component is critical. I mean, it's money in people's pockets and their buying power. So it's magnified by all the financing and everything from cars to houses to retail debt. So low unemployment, in theory, is supposed to trigger wage inflation. And there is some wage inflation, but it doesn't appear to be nearly where it needs to be to sustain the debt growth that we are going through. So that's the relationship. That's the theoretical relationship. And if economy softens and unemployment rate gets worse, then the wage inflation will weaken as well. And without strong wage inflation, it's pretty hard to see GDP growing. So that's what everybody's trying to do, is to push wage inflation up, and that'll solve kind of all problems. That's my thoughts on the subject.
Right.
I don't have crystal ball to predict exactly what wage inflation is going to look like, but I do think that we are going to we reach sort of an economic peak. We're now into down cycle, and that means that unemployment is going to get worse, and so inflation is not going to keep up with the ideal scenarios. It's going to be somewhat worse, and low inflation, in theory, will push the rates down as well. So
when you look at the chart of unemployment, it is not ever the case that unemployment just levels off when there's a recession. It's pretty volatile in the sense that you bounce around between 5 and 10%, and the bounces are pretty significant. Like, you can look at the employment rate and you can tell exactly where the recessions are because the point turns around. Now, part of that's because of the media, when they perpetuate the fact that, hey, we're in a recession, hey, the yield curve is inverted or whatever, businesses, they tighten up and they stop hiring and they may start firing. And I think that that's actually going to be compounded more and more. Ever since 2000, we've noticed that these tweaks in employment in particular are quite significant. And I think a lot of that has to do with the access to information. So right now, everyone's watching the yield curve. 20 years ago, people didn't have that access to information because the internet wasn't really around much. So it's pretty remarkable what a technology change like that can do in terms of access to information, in terms of potentially increasing the volatility of a recession, especially in the stock market. Now, I wanted to talk real quick about, interest rates not directly related to real estate. So I think that a lot of people, when they think about interest rates, they think, okay, well, this is the amount of money that I can buy a house with if the interest rate is this, et cetera. But the truth is, interest rates are pretty much underlying every transaction that takes place. So from your perspective, when interest rates rise, what impacts ripple through the economy other than just real estate transactions, for example?
Look at the cars. So automobiles, cost of financing is a big deal. So generally speaking, when the cost of financing goes up, it will slow demand. This is true for pretty much anything because consumers are just used to buying on leverage. They, anywhere you go, furniture stores, any big ticket items get financed. Not on every level, but a pretty significant number of these transactions are financed. So rising interest rates impact all sectors of the economy that the payments, affordability of the big ticket items just worsens. So the demand weakens. Depending on the elasticity curve, whatever commodity or item we're talking about, there could be a significant impact or not. So if you're about to go to college and you want to get education and the interest rates move, will you not go to college? Well, the chances are you will go to college and you'll pay slightly high interest rates on a college loan and it'll be deferred. Right. So certain parts of the economy are not as impacted. But if you are looking at your car payment and you have a $400 a month budget, and now that $400 a month car costs $500 a month budget, will you step up or will you scale down? And the decision varies, but economic pressure is there for you to look for a little bit more of a bargain. So the car manufacturers will be taking, will be taking it on the chin. So that's one big, gigantic, sector that is impacted. Now you're talking about non-discretionary, non-critical purchases, vacations. So let's just call it the whole vacation industry. Now people don't go on vacation on loans, but they do put stuff on credit cards. And as interest rates rise, credit card companies already charge pretty high rates. But if they have to push those rates up a little bit more and people don't have the ability to pay, the balances increase, that'll be, in general, pretty bad for the consumer liquidity and their balance sheets. So none of this stuff happens overnight. But your previous point was this. Because of the age of internet, of the Facebook, of the Twitter, and all the great communications and Google, sort of bad events or bad news travels fast. So the impact is when we look at the stock market, when a little bit of a bad news happens quickly over a very short amount of time, the market finds a lot of volatility and starts going down at a rapid pace. So these moves are sudden and significant, and that typically happens down. On the way up, the market moves slow in measured steps. So if there's another mini crisis, we're going to see, significant fluctuation quickly, and the economy can go from chugging along just fine into suddenly a recession fairly quickly because of consumer confidence. And if the consumer confidence shakes, there could be a chain reaction that takes place rather quickly, and we suddenly will be showing bad data, and the vicious cycle starts. Bad news travels fast. Consumers start getting nervous. It sort of happened a little bit in October, November timeline. There was a lot of nervousness and stock market responded just because there was uncertainty. This whole trade war and sort of just the fact that the Fed has been raising rates too fast and affordability start being hurt. When the news hit, that's where you see kind of very sudden and impactful changes. So I follow this theory that when the bad news happen, they travel fast, and there will be very significant corrections, and we can wind up in the middle of a recession a lot faster than we realize.
Agreed. Now, there's something that I interviewed someone about a long time ago, Ethan Pinner, who brought something to my attention that's really stuck with me, and I want to get your perspective on this. So when I look at the graph of the last 100 years of interest rates, let's say the 10-year bonds, for example, it paints an interesting picture. It basically says that the current environment is actually pretty normal, and the aberration was really what took place from, let's say, 1965 to 1985, where you had this massive increase in interest rates. And I know this sounds a little bit odd, but when you look at the chart, if you remove that, everything else is pretty much within that, let's say, 2 to 4% range from federal funds rate, for example. What do you think about that, in the sense that we have opened the Pandora's box of quantitative easing, something that previously had been implemented to one degree or another, but certainly not to the extent that it was implemented in 2008. And now the entire globe is doing it. It seems like now that that cat is out of the bag, we could be in a perpetual, quote, low interest rate environment, rather than seeing that 7%, 8%, 9%, 18% that we saw in 1980s. What do you think about that?
I agree with the theory in general. I think we will never see double-digit interest rates unless there is massive problems in the economy here. The quantitative easing will keep the rates artificially low. I am sort of a proponent at this point of a grand conspiracy theory. The Fed just can't, well, not the Fed, but the U.S. government can't afford much higher interest rates. So Fed had to raise a little bit, sort of give them a future ability to drop the rates when there's a bigger problem. So the theory holds that the quantitative easing is a way for Fed to push the rates down, and they'll continue to do that to avoid high interest rates. And as we can see, that the last 2 years, the rates on the absolute basis haven't gone up that much, but on relative basis, they've gone up quite a bit.
Right.
So the U.S. consumer and the whole economy has been on drugs, addicted to the lower interest rates environment. And now the withdrawal is extremely painful. So they have to stop the withdrawal. It's an addicted consumer. So again, comes down to income growth. If they can't trigger real job inflation, then the only alternative is to keep the rates down. And depending how things play out, we're likely going to see low interest rates for a long time in that range, just to sustain the debt balloon that's out there on every level.
Agreed. And I think it's interesting about the conspiracy theory. I try to stay away from conspiracy theories as much as possible, because I find that it doesn't really help me get my point across, and the fact that the people think you're crazy doesn't really help you in terms of changing anyone's mind. However, the things that I do find very compelling are basically saying, look, let's say it's not a giant conspiracy. Would it be any different? Like, in the sense of, like, would the actions be exactly the same? So it's like, so it doesn't matter whether or not it is. It's pretty much exactly the same. So we're just going to go ahead and say it isn't, but yeah, pretty much. So
it's the laws of economic gravity. Effectively, what's happening is the rates have to come back down. So yeah, even without the grand conspiracy theory, I think we're all moving towards sort of Japan model, as you mentioned. So I'm in agreement with you. In the long run, if the debt to GDP ratio continues to be bad, and that's a function of political environment. Mm-hmm. Politicians can't seem to balance the budget. There's no incentive for them to be fiscally responsible. They want to get reelected. They give away too much. There's so much more incentive to keep running deficits. And I don't know if you looked at some of these projected curves. There's a theory that by 2025, virtually entire federal budget will be at least all the taxes collected. If you didn't go into debt, you just took the revenues, you'll be paying entitlements plus the debt service, and we're going to be there in that point soon enough. I mean, we're not that far away. We're only 6 years away. Even if the prediction doesn't hold and it's not 2025, but a few years after, it's the same issue. The issue is just the fact that the deficits continue to get bigger and bigger. And if the rates don't go down, that the debt service will be a squeeze. Now, we're talking on the other side, you got entitlements. And entitlements are unfunded liabilities, which are converting into actual debt every year as more people retire and they need those benefits. It's creating essentially a drain on the economy that the non-producing sector of the population. With all due respect to older folks, they are non-producing members of a society. They're consuming members of a society. And they unfortunately have to be sustained by the working folks. So that ratio of number of working people relative to the number of retired people receiving benefits is historically low. So if we look at that, the only way to sustain that is just keep borrowing, keep increasing national debt, lowering the rate. So it doesn't even matter what that national debt figure is if the rates are zero or near zero. So in the long run, debt to GDP ratio could be like Japan or worse. If the rates are low, hey, keep running this thing deficits and keep borrowing money. What it really does, it devalues the dollar over time. So that's where we're going.
So let's circle back to real estate real quick, because there's an interesting conversation to be had about the relationship between cap rates and interest rates. So I was hoping you could describe how these two metrics interact with each other in theory, and then we can talk about in practice in just a moment.
Sure. So in theory, as interest rates rise, they push cap rates up as well. This doesn't happen overnight. It happens when the prudent money comes in and dumb money goes out. So dumb money will continue to pay low cap rates, basically paying top prices. And they're paying too much for a dollar of income. And that's what the dumb money does. The smart money comes in and says the cost of financing has gone up. The interest rates have gone up. Now, for the same property with all the same characteristics, same net operating income, because of cost of financing is up, in order for them to receive the same level of cash-on-cash return, they need to get a better price. In other words, get a higher cap rate on the acquisition so that they get a little bit higher NOI, and then they get, let's just say, the same cash-on-cash as if they got in the scenario where the interest rates were lower and then they paid a higher price. So that math, I mean, it doesn't work exactly like that, but directionally, this is what happens. People want to get 8% cash-on-cash return. So if the interest rates were 5%, they might have paid $10 million for something. When the interest rates go to 6% on a mortgage, they can no longer afford to pay $10 million. They now got to pay $9 million. The price has to come down. So that's the relationship between the interest rate and cap rates is they move in the same direction, but they don't move at the same speed. So typically interest rates are ahead of the cap rates. And then as dumb money cycles through the economy, and then they realize that they are overpaying for the assets, they'll withdraw. The cash buyers, the Chinese money, all the foreign money that's coming in just to buy something in the United States, they don't care about the yield. When that dries up or slows down, then the prudent investors come in and then they start looking at the cash flow of a given asset. And if they don't see significant ability to increase rents to offset the higher cost of financing, then they wind up with the environment where they have to pay less. That's what will effectively increase cap rates as interest rates go up. Does this make sense?
Oh, yeah. You definitely touched on a lot of things there that I want to circle back on, because that's really the bulk of this whole thing as it relates to real estate. One really important thing that you mentioned, I like the way you phrased it. So you say, let's say you want an 8% return. Well, and then you have a significant increase in interest rates and you're still trying to get that 8% cash on cash return. Well, what the terminology used was, let's say you were paying $10 million for a property based on its in-place income. Well, now you can, quote, no longer afford to pay $10 million because that interest rate has risen to still get that 8% cash on cash return. The only way you can get that is to actually just only pay $9 million. And this is how the change in interest rates can impact the cap rates and therefore impact the purchase prices of properties. But you also touched on the fact that there's a lot of different dynamics in the world, and there's a lot of reasons why these things don't always work that way. One of the reasons is that some people just want to invest in American real estate. They want to get their money completely out of, let's say, China, and they want to dump it into Southern California. That doesn't really have much to do with interest rates. They're willing to do that regardless of what's going to happen. Some people may even want to pay to get their money out of China. So then every book you ever read in business school is completely out the door. So it's really interesting because this, over the long term, we will see interest rates and cap rates move pretty much in lockstep. But that's the long term is not the way that investments are made. The long term is kind of the average, the aggregate. And so it's an interesting conversation to have. I think you touched on a lot of things there that are all really important. Now, we're going back to money printing. it's kind of interesting because we don't, like I said, don't really have a good understanding as to where interest rates would be, because it's not the US that had a massive experiment of quantitative easing. The ECB has also done a tremendous amount of that. And so because of that, when the ECB does it, that means interest rates there are low. That means there's more demand for American bonds, which means that more people buy American bonds, which means that the bonds therefore are there lower as well. So from your perspective, how can you see through the weeds to understand where this market would be in absent of all that central planning and money printing? Or is it necessary?
Well, it becomes a very hypothetical question. It's really hard to answer where would we be if they didn't have ECB or they didn't have Fed. Central banks exist, and central banks continue to weaken their own currency. So they want their own exports to be more attractive. They want to improve their own economies. So everyone is weakening their own currency, and I don't know where the equilibrium is. It's just been
but nowhere near here. I think that's fair to say.
It's been manipulated to the point where it's a very hypothetical question. It's very hard to give a very hypothetical answer because of all these manipulated interest rate environments.
That's totally fair. I think the real point there is that we have no clue. And because of that, there's been a lot of people out there, sound money proponents, people that are advocates of the free market, people that are advocates of the gold standard, for example, that have been anticipating that we would have some sort of collapse based on rising interest rates, hyperinflation in the US for quite some time. People that have been writing the same book for many, many years. And we haven't seen that. So what are your perspectives on that, and how long this can really go on, or what some of the factors that have been able to allow this to go on for so long?
Well, I happen to be a libertarian, and I wish we were on some level of a gold standard, but that's the dream that is long gone. And the crypto guys nowadays believe that that's the new gold, Bitcoin, and they think that it'll continue to inflate up just because the fiat currencies are working under the printing press doctrine. So, it's we are not going to get off the current monetary system. The dollar is still kind of global standard, and we'll continue to do what we do. I don't know if this is how Roman Empire collapsed. Maybe all empires collapse at some point that they can't afford to defend themselves because they got themselves in so much debt. The beauty about the current environment in Roman Empire, they couldn't print the same money. They did kind of coin shaving and all kinds of other things. But the paper money, the printing press will just keep printing more and more currency. And at some point, I don't know if it's going to be a shenanigan that might happen, but the U.S. essentially will forgive its own foreign debt to the printing press. So it'll be $100 trillion national debt, and it'll be only worth in nominal dollars, if you go back, half of what it is today. I mean, this is a joke, but this will continue. Every country will continue to do that, and they just keep kicking the can. So there's no end in sight. Let me put it this way. This is going to continue as long as it can continue, unless there's a major global economic crisis, some kind of a black swan event, and there's going to be war or something global where I don't even know if it's what's going to happen to the currencies. It'll continue to make currencies worse. People will need to get paid to go to war. So the governments will just keep printing more and more, going to deeper and deeper in debt. One day they can do a reverse split, 100 current dollars for one new dollar.
Right.
Or it'll be like Yugoslavia. I mean, it's not going to be that fast in the U.S. It'll take many, many more years. But you'll see $500 million banknote or something like that. The joke here is that this will continue. They don't have to print more dollars, just print more debt. They don't have to increase money in circulation. They just increase effectively the balance sheet. That's all that's been going on, and it'll continue to be. And so I don't know if I answered your question, but that's
well, they could just add a zero to the bank account by just typing it in. So that's pretty much the extent of it at this point.
A zero or two zeros.
Sure. So, okay, so we've obviously done a lot of predicting in this, and I do appreciate it because I know that it's kind of pushing you outside of what you're comfortable talking about, given the fact that it's really hard to be accountable for some of these perspectives, given that our information is very limited and it's unpredictable. But let's say this will be an easier prediction, and I'm definitely interested to get your perspective. Over the next 12 months, where do you anticipate interest rates being? Do you anticipate there's going to be 1 or 2 raises over the next 12 months?
Yeah, as I said, my crystal ball broke a long time ago, but I'm going to guess we're looking at the Fed rate 50 basis points higher. Okay. I think they'll stop. So the neutral point will come around 50, maybe a quarter, maybe 50. I don't think they'll get to 75 basis points. So when I make an average 50 basis points and they stop.
Fair enough. I'll accept that. Now, before I let you go, Mike, again, I really appreciate you coming on. We've covered a really important topic in a lot of detail, and I really appreciate it. But before we jump off, let the listeners know, more about your firm, how they can reach out to you and learn more about what you do.
Sure. So the website is bigmikefund.com. That'll take you to the podcast. And if you mistype it, bigmikefund.com, it's not a kinky site. It's just you'll wind up in the same place. And
okay. You bought both URLs to avoid that problem.
Yeah, we got both URLs. It's tempofunding.com is the main website. I'm a fund manager of our flagship fund is Tempo Opportunity Fund. We invest in a diversified manner across many value-add project syndications in multifamily, self-storage, office, retail. We also have a significant hard money portfolio secured by, firstly, mortgages across the board, and with the same folks we've been working for a while. It's fix and flip projects, kind of a lot of the turnkey loans. This is the space we like, small loans. So that's what we do. It's a fund that diversifies across the board, and we generate strong income. It's basically income and growth fund, and it will provide decent amount of growth through the value add work. So that's what we do. As I said, you can find more information on our website, and happy to answer any other questions. And personally, what I love to do, my genius zone, I absolutely love to look at the various commercial deals, multifamily value adds, retail, self-storage, and enjoy underwriting, enjoy picking and choosing the battles. We try to pick good sponsors with good quality, good experience, high integrity, solid projects, professional splits, and good exit strategy. And that's what we do. I mean, that's the crux of the business is essentially capital management for the long term with high degree of predictability. Again, it's income plus growth, not the other way around, especially in this environment. Yeah,
I appreciate it. And we'll make sure to list those in the show notes page. Mike, thanks again for coming on. I really appreciate it.
Thank you, Hunter, very much. Thank you. And I hope you come on my podcast, bigmikefund.com. And I'm looking forward to have you as a guest as well.
Awesome. Thanks again.
Thank you. Take care.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.